Hello everyone and welcome to this very exciting episode. In this episode we are going to talk about taxes. So tune in and stay on board. So before we start, since we are going to talk about personal taxes a lot, so I have to read this disclaimer. So this podcast is for general information only and we are not tax experts nor we give any specific tax advice. Each individual and family situation is very unique and needs to be taken into consideration. Income tax amount, inclusions, deductions and tax credits change in type and amount in every year, sometimes twice a year. What is eligible last year might not be eligible this year. Use the CRA website for more information, call Canada Revenue Agency for assistance, or have a professional CPA look at your tax returns. Thanks, Val. It's nice to be with you. So before we start, what are taxes?
Taxes are revenue that is given to the state.
Okay.
That is what a tax is. Tax can come in many forms.
Mm-hmm.
It can come in income tax.
Mm-hmm.
It can come in property tax, education tax, carbon tax. It can be what we call a sin tax. That's our alcohol and cannabis and tobacco has an extra tax on it. Tourism tax, hotel and tourism tax, land transfer fees. So taxes can be levies. They can be your license, getting your license, registering your car. All these are ways that generate revenue for the government.
So just to boil it down a bit more. So if we are let's say a family of two, and we both are working, husband and wife in a typical, or any partners working in a typical situation. So what tax on an average do they pay?
So that totally depends. If we're talking income tax now, I think we're focusing on income tax, right? Income tax is a federal and provincial jurisdiction.
So once again, when you earn some income,
yes,
out of that income, some part of it goes towards income tax.
Yes, correct.
And in Canada, those who are new, we pay it at two levels.
Yes.
So we pay federal income tax and then we pay provincial income tax. Okay.
And if you are a resident of Canada, you pay income tax on worldwide income.
Okay.
So it's income earned anywhere in the world.
Yes.
You are taxed on it.
Yes.
Now, if you follow in with tax treaties,
yes,
then that is subject to rebates and stuff like that due to tax treaties. We have tax treaties with over 200 countries around the world.
Okay.
Okay? But your worldwide income, you must claim it first and then claim your tax credits, international and foreign tax credits afterwards.
Okay, so that was one tax. You earn some income, you pay a tax out of
Correct.
that. The second one probably that you said was when you buy stuff, you do pay taxes
We
too.
pay GST, value added tax.
So
Correct.
it's a value added tax. So when I go to, let's say, shop and buy, let's say, a case of beer, right?
Yes.
Just making stuff up. So I do pay some taxes on buying that.
You'll pay environmental fee on the bottle or can that you're purchasing. You will pay alcohol tax on the alcohol, both provincially and federally, and a tariff tax if it comes in from other provinces. And then on top of all that, you will pay GST.
Okay. So those are all taxes when you do a simple buying a case of beer in a grocery store. So sales tax, GST and whatnot you said. So that is third. Then if you own a house, I often see that every year I get something from the city.
Yes.
And it has something called property tax. So can you just
two things on
explain
that? You have property tax and education tax, and those are based on a mill rate. So a mill rate is just if I'm in the lowest tax bracket income-wise, I pay 15%. So the mill rate could be 1.23% of what the property value is. Okay. And then they also have that, depending on your property value, you have to pay education tax on top of that.
Yes.
So that amount comes in to the municipalities to go out towards the education.
Okay, so when you own a property, you also pay tax.
Yes.
Then if I buy and sell some asset, right, there is this capital gain tax. So can you...
And that becomes income.
Okay, that becomes
Okay,
income.
it's considered income. So capital gains in Canada right now has a 50% inclusion rate. Meaning that if I buy a stock okay, for $100, and I sell it tomorrow for $200.
Yes.
I've made 200 minus $100 in gains.
Yes.
Right? 50% of that is the capital gain that is taxable.
Okay, so out of that $100 gain,
Yes.
$50 is taxable.
Yes, and so it gets added, it becomes income.
Income.
It's part of income.
Okay.
Okay?
Then there is a lot of noise about carbon tax. So what is carbon tax?
So carbon tax, there's two carbon taxes.
Yes.
There's an industrial carbon tax and a
Yes.
personal carbon tax.
Okay.
So the personal or consumer carbon tax that's the one that they throw on at the pump. That's the one that comes in on your gas line coming into your house or your electricity or anything like that. That's a consumer tax. You're consuming, you're paying it. They
Yes.
also have an industrial carbon tax on metric tons to any industry that emits carbon.
Yes.
That's every industry there is.
Yeah, that is true. Everything.
Yes.
Yeah.
Making solar panels, which
Yes.
we don't do in this country, but if we did,
Yeah.
that emits a lot of carbon.
Yes, that's true. So everything that, like all industries,
Yes.
like effectively emit carbon,
Yes.
and whatever carbon they emit, they have to pay a
Yes.
tax on that.
Even
so that's
data
on the
centers.
industrial side. So how about personal side? Because I see carbon tax sometimes on my like utility bills, for example.
That's the consumer one.
Okay.
Right? You're consuming electricity.
Mhm.
Electricity takes carbon to make,
Yes.
no matter what type.
Yes.
Right? Whether it's a coal burning plant, a gas plant, or hydro. Although hydro is definitely cleaner.
Yeah.
Right? But still there's a carbon footprint there. You
Yes.
had to make that hydro turbine. You had to pour hundreds and thousands tons of cement.
Yes.
You had to make that cement. That cement was made into a plant that was either powered by gas or powered by coal.
Yes.
Right? So everything is intermittent. Nothing does not produce carbon. Everything produces carbon.
So everything produces carbon, and we pay taxes on everything.
Yes.
So effectively what we talked about is we pay income tax from our
Yes.
incomes. We pay tax if we own a house, property tax. If we buy and sell stuff, right, we
That's
pay capital
included in
gain
income.
tax,
Yeah.
right?
Land
Then
transfer fees.
land
That's a
transfer
tax.
fees. So when we buy land or we transfer land, we pay tax.
In BC and Ontario.
In BC and Ontario,
Yeah.
not in Alberta.
Not yet in Alberta.
Okay. Then we pay GST, right? Sales
Yes.
tax, value added
Yes.
tax on everything we buy
Yes.
and sell, everything, right? Then we pay carbon tax. So
Yeah.
anything we missed.
In the Enviro fee, when you go and purchase a can or a bottle of pop or water,
Oh, that's
you've got
tax too.
2 cents or a 7-cent Enviro fee.
Yeah.
Now you have a recycling fee also on that, but the Enviro fee you don't get back,
Yeah.
right? That's a tax.
So we pay so many taxes, and
Yeah.
like if I just was reading for preparation of this episode, and 40% of our gross domestic product is taken away in taxes and fees by the government, right? At
Correct.
different levels.
Yeah.
So it's not only one level, it's
Yes.
different level. So what do they do out of it? People may
Well-
not understand, right? Everyone hates taxes, but what do they collect the taxes for?
So taxes are a good thing. We have one of the highest tax countries in the world, but we also have one of the highest standard of living. Okay? And that is due to some of the social reforms we have.
Yes.
Okay? So the firemen are
Yeah.
there. I don't
So
have to use it. thank
taxes
heavens.
pay for that.
But taxes pay for that.
Yes.
The policeman's not there.
Yes.
But I might need him. Do I
Yes.
like it when he pulls me over speeding?
No.
Not so much. However,
Yeah.
if I ever was in a situation where I needed assistance or had a break-in or something, I would
Yes.
love to have those policemen
Yes.
there, right? The hospitals are there.
Yes.
Education is there. Like not only does the education tax on your property go to education, but also some of the income tax gets kicked back into that.
So people would not know, like we have a public schooling system where schooling is free.
Yes.
And it's not free because someone pays for it.
That's
and
right.
it is the property owners that pay for it
It's
through
the
taxes.
property owners that pay
Yes.
for it. And income tax. Now property owners, remember, if you are renting, the owner of the rental building is paying property tax
Yes.
and school tax
Yes.
on the cost of that property. So
Yes.
it's in your rent.
Yes.
So even though you think you're not paying it,
Yes.
you're paying it.
Okay. And where does the healthcare come from? Like we have free healthcare.
comes from income tax.
So it comes from income tax.
Yes, it's not free.
It's not
It's
free.
free to the consumer of it. It's
Okay.
not free to the
Yeah.
people who are in income because you're paying taxes
Yes.
to bring that back.
Yes.
So this is where I don't mind giving the government money. I just wish they were a little more responsible spending it.
Everyone does.
That's all, right? Of course, I say that to my husband too. Be more responsible spending my money.
Okay, so that's a good segue. So, like, let's take different life situations and we can talk about some things they can do to probably save on taxes or be more efficient with taxes. That's a better way to put it.
So, I always say, you want to pay your taxes. So we get a lot of benefit back from it, right? But you don't want to pay more than your fair share.
Yes.
You want to pay the minimum amount of taxes you are required to pay within the spirit of the Income Tax Act.
Yeah. So people, please don't open companies in Bahamas and avoid your taxes.
Well, unfortunately, the Income Tax Act allows that, right? That is not illegal. It may not be ethical or morally right for a government official to deliberately do that.
Yes.
However, it's not illegal.
Yes.
And you got to remember, they have to think of their shareholders too.
Yes.
The board has a fiduciary responsibility to the shareholders.
Make the maximum.
To make the maximum amount of money.
Yes.
Yes.
Okay, so that's a good segue. So I'm a single, so let's paint a situation. So people who are in this situation will relate to it. A single person, right? Renting right now, going to school, right? So education is going on by the time they're working part-time, not much income, right? Barely like few hours a week or something like that. Young person, and he or she is going to school too. So should they file taxes because their income is not much?
So Canada tax system is a self-assessment system. You are required to self-assess and file your taxes if you owe money, if you disposed of real property, or if you have a capital gain. You need to file your taxes.
Yes.
Other than that, if you don't owe the government any money, you don't have to file your taxes. But there's a lot of benefits to come in filing your taxes.
Let's say that person has like $10,000 income in the whole year.
Wouldn't need to file his taxes technically, right? However...
But is there an advantage?
Definitely. He could be eligible for the GST rebate.
So what's a GST rebate?
The GST rebate is where for GST hurts lower income people more than higher income people, right?
Okay.
So 5% of $100,000 is quite a bit of money.
Yes.
But it's 5% of some discretionary income.
Yes.
If you're only making $10,000, it's still 5%.
Yes.
But that 5% is money that you actually need to live on.
Yes.
Right? So that's the problem with GST. It hits everybody. Okay? So with the GST rebate, those in lower income tax brackets get a rebate back from the government, the federal government.
Yes.
Based on the income they paid, they calculate how much GST you've paid and they give it back.
So if you have a $10,000 income, right? You're not earning much, you're a student going full time to school maybe. And if you file your taxes,
you will get
most likely you would get a refund because you don't have much income and they repay the GST that you have paid during the course of the year.
That's correct. And then we have that carbon tax rebate too.
Okay, so carbon tax rebate.
Which is gone now, but we will, this is the last month we will get the carbon tax rebate depending on your income level.
Yes, so it's a good idea for people who are like a student earning $10,000 to file the taxes.
Yes. And Prime Minister Harper upped the working income tax benefit. So the working income tax benefit are for lower income people. You get an extra benefit, pay less taxes on the 15% because you're earning such a small amount.
Okay.
And you also have guaranteed income supplement. If you're a senior and you're making less than $17,000 a year, then they will top that up with a guaranteed income supplement. And what
that's available for students too?
No, that's for seniors.
Okay, that's for seniors.
Right.
Okay.
But students have, you file, you record your education tax credit.
Oh.
So you can't use it right now maybe.
Yeah.
But you can store it and it's stored forever.
So when you're making money, education tax credit.
So an education tax credit is if you're going to a recognized educational institution or you're taking certification exams
Yes.
or anything like that, they give you a credit valued on your cost of your tuition and or the cost of doing those licensing exams. Okay. So that gets stored at CRA under your SIN number, social insurance number, right?
Yeah.
Because as a student, you're not making any money.
Yes.
So when you're actually making money and now you're paying taxes,
Yes.
okay, you can take that and it comes back to you as a whatever dollar amount, 15% of whatever you can use to reduce your liability. So you use it when you make more money.
Wow. So I didn't know that.
Yeah.
That's a good point.
So
you get GST tax credits, you get you used to get carbon tax credit, plus you can store your education tax credit and use it when you earn higher income.
Yes.
So it's a good idea to file taxes.
Definitely. Now remember, a lot of students are supported by their parents.
Yes.
And they might have transferred the right to use those tax credits to their parent.
Okay.
So the parent might be taking the tax credit.
So that's another angle that you need to
you need to
think
pay
about.
attention to, right?
So two more sources of income that students have along with earnings is they might have some scholarships or grants.
Yes.
So is that taxable?
That's income.
Okay, so that's still
That's
treated
definitely
as
income.
So
You need to include it into income.
it and you have to file taxes. Yes.
However, a lot of times what they do is they offset it. If you're full-time, they offset it with a scholarship deduction.
Oh, so there is a scholarship deduction
Yes, but it all depends on the dollar amount, if you're full-time, part-time, and how much the scholarship is.
Wow, so good research point for students. If you have grants and scholarships, that will be treated as income.
Yes.
But you might be able to claim some scholarship credits for that.
That's right. And usually if you're full-time, it's usually a wash. However, it all depends on a lot of your situation. There's nuances in the tax code, right? It's like who's giving you that scholarship? Who's giving you that grant? Right? Are you related to the people that are giving you that?
Yeah.
Right? There's all kinds of rules, right?
Amazing.
And also, I think it's P105 is the student guide. So you need to go on, if you're a student, you need to go on the Canada Revenue Agency website and go in student tax guide. And it's nice, lots of white space, big print. Read it through, know what you get to claim. Because if you have a student loan that's government given, federally or provincially.
Yes.
I'm not talking about a student loan that they say the bank says, I'll give you this student loan.
No.
That's not what I'm talking about. I'm talking about a government issued student loan, federally and provincially. Well, you don't pay that back until you finish whatever you're doing and you're out graduated for 6 months or maybe you failed or went out in the workforce.
You don't make payments.
You don't make payments. When you start making payments, you start paying interest. That interest is a tax credit.
Wow.
And if you can't use it, say you're not making quite enough money, you've got all kinds of deductions, can't use, like if you took it, you'd waste it, you're not paying enough taxes, you can carry that forward 5 years.
Wow. Amazing. So that's one point, like if you have a student loan and you're paying some interest, like just look into it, like if maybe you can claim some credits on that. Then if you have some family help in form of RESPs and stuff, right? Is that income?
That's income.
Okay, that's income.
When you pull the money out, it's income to you.
Okay.
But you're a student.
So your income levels are low.
Yeah, so you should be right? You're not. You don't earn a lot of money.
So file your taxes, right? Read the CRA student book.
Yes.
And there are lots of things you might need to consider and like might be beneficial for you to get the GST tax credits and stuff.
Also, filing your taxes shows that you're a resident of Canada. You're clicking off whether you're a resident or you're filing as an international person.
So that might help in OAS and stuff.
OAS. How do you prove you've been a resident of Canada for 40 years?
Yes.
If you've never filed an income tax return.
Wow. So it's an important thing for when you claim the pensions from the government. That's a great point.
And a lot of times going in for a loan. What do they ask for? What's your notice of assessment?
Yes.
That shows your income.
Yes. Now, one thing I looked at, like if a student is, let's say, coming from Nova Scotia to Alberta for studying, so whatever expenses he or she incurs while traveling, can they claim that on their taxes?
They can claim it against grants, scholarships, income earned as a student for being a student.
Okay,
right?
so that's one more point, that make a note of all the expenses while you're traveling for school, so you can claim that.
There's an easy way and there's a long way, right? The airplane ticket,
yes,
right?
Yes.
So there too, if you fly and get a job, if you move to get a job,
yes,
that's a move.
So that
if you
will
move
be
40 kilometers, more than 40 kilometers
Yeah,
to be
that's a
closer
move
to a
to
place
do.
of work, that's
Yeah.
right. Then that move is eligible for a tax credit, moving tax credit.
So the student part is like more or less we discussed the high level part, like where they can claim. Right? Anything we missed out, like a young person, rental income, you can't do much there.
Not here, but there's some provinces that rental income, if you're in a lower tax bracket, you actually get more tax credits by renting.
Okay, so not in Alberta, but if you're in other provinces, like look into it.
Yes.
The rental income that you're paying may make you eligible for credits.
So remember, if you're moving, that means you're filing in the new place of location. But if you're just flying, but you're living at mom and dad's still, you're still filing your taxes as if you're in Nova Scotia.
Wow. Makes sense. So that age group is, let's say, done. So they move on and they're working, they got like married, or they're in partnership. And so what's for them? So what all tax strategies or tax things they can look at? So a young couple, let's say, both of them are earning.
So unfortunately, there's not a lot for a young couple. You file as an individual. Okay? So the one thing you do have as a young couple is if one earns a lot more money than the other, and the other one's below the basic personal amount.
So basic personal amount
that's a deduction. The government says, okay, so I'm just going to ballpark some figures because I don't get exact. So say federally, you get $19,000 as a tax credit. So if you make $19,000, you're in the 15% tax bracket, you're taxed 15% on that.
Yes.
But you get a $19,000 personal basic amount times 15%, so that offsets what you paid, so you get that money back.
Oh, okay.
So that means your first $19,000 you earn essentially is tax free.
Yes.
But say that my husband earns $50,000. I'm only working part-time because I'm going to school.
Yes.
Right? So I'm only making $10,000.
Okay.
So that means there's $9,000 of unused tax credit I cannot use.
Yeah.
So that can be transferred to my spouse as a spousal amount.
Wow.
Right? So I can transfer my education tax credits to him so he can claim them. So anytime you can claim money now and use it and get the money in your pocket, time value of money, it's worth, the dollar's worth more now than it is in a year.
Yes.
Right? So I can transfer my disability to him.
Okay, so if you're earning less, it's great idea to look into those things.
Whether you
because you can transfer some stuff
instead of losing out on it.
Now most couples, when they start earning, they start thinking about investments, right? So we have different accounts like TFSA, RRSP, right? That is relevant. So what are those accounts? So let's start with TFSA.
So TFSA is tax-free savings account.
Okay.
An awesome vehicle.
Okay.
So you don't get any benefit putting money in. Okay, so you don't get to deduct it or get a tax credit for it. So it's money after tax dollars going into a registered account, a registered tax-free savings account. Any money earned from that money in the account is yours tax-free. So any dividends, any capital gains, right? Any stock splits or anything you want to sell, no problem. Anything that goes on in that account has no impact to your income, even when you take it out.
Okay.
Right? However, if you have a capital loss in there, you don't get to deduct it either.
You cannot claim it.
You can't claim it against future capital gains.
So just to make it a little bit easier for listeners, if I buy a, let's say, Royal Bank, right? $100 I put in, I got the stock at $100, it's 2025. I leave it there for 20 years. I forgot it was even there, and that stock is, let's say, now $200, right? So 100 I bought, 200 it is right now. So if I sell and take out my money, no taxes.
No impact.
No impact at all.
No impact whatsoever.
Okay.
But you lose, like I said, if it became $50,
yes.
you don't get the loss,
Yes.
right? And you don't get the dividend tax credit.
Okay.
Okay?
So good idea to put, let's say, safer stocks and like safer investments.
Well, there's two stories to that.
Yes.
Okay? There's one that says you should put guaranteed income earning stock in there, then you're guaranteed, right? Bonds, treasury bills, right? Blue chip stocks, like banks and stuff like that, right?
Yes.
Should go in there because your guaranteed money will be coming into them, right?
Yes.
But then there's also the one that says, you know what? Those are the ones you're going to put in there and try to find those unicorns.
So like
You want to gamble,
yeah.
right? For example, say, what was it, 5 years ago, 6 years ago,
Yeah.
when cannabis stock was went from $2 a share to $300 a share?
Yeah.
If that had been in your TFSA and
No
you'd sold
taxes.
it at the 300,
Yeah.
then you went from $2 to $300, you made a $298 gain,
Wow.
right?
Yeah.
But now they're back down. If you bought it at the 250,
and it
thinking
goes-
it was going to keep going up, and
Yes.
now it's down to $2 again,
Yes.
you've lost
the money.
that $248 and you can't claim it
Claim.
against any other gain.
Wow. So there are two sides to it.
There's two sides to it.
Yes.
You need to do what you feel
Yes.
comfortable,
Yes.
and you should be knowledgeable about investing,
Mm.
or you need to go to a certified financial
Planner.
planner, or a CFA.
Yeah. Now the second side of it that people might not be aware, like Canadian stock dividends are not taxed at all in the TFSA,
That's right.
right? But if you buy an American stock, let's say you buy JP Morgan instead of Royal Bank and it pays regular dividends, then is that taxed?
It's taxed in the States.
Okay.
Right, and you can't get that back as a
You
foreign
cannot
tax.
get that
Even
back.
though we have a tax treaty with them, you can't get them back.
Wow.
However, if you bought that Stanley JP Morgan outside in a non-registered account,
You can get
you
that
claim the dividends into income with a gross up.
Yes.
You get a tax credit,
Yes.
and on the money you paid in the States to that
Yes.
dividend, you can claim a foreign
Yes.
tax credit.
So something to think about, if you are buying American dividend stocks, it's better to buy them elsewhere.
Yes.
Right, and if you're buying Canadian dividend stocks, there are
Yeah.
tons of it,
Yes.
right, and they pay better dividend than Americans do. So it's a good idea to get into a TFSA and get that.
You got to think about that when you're
Yeah.
doing it, right? It's something.
Yes.
Tax planning is huge.
Yes,
Right, when you're thinking of how, and your comfort zone.
of course, right. It is up to each individual.
That's right.
So that's TFSA.
Yes.
So what is this RRSP?
So, registered retirement savings plan, okay, is where the government will let you put money away from income earned this year. Well, actually last year. It's a year behind. They
Okay.
base this year's contributions on last year's income.
So let's put some numbers in. So 2024, this is 25, so 24 will look
So
at.
say I made
I made
$100,000.
Yes.
So, and depending on whether that contribution room is impacted on whether you have a pension plan you pay into.
Yes.
Okay, so there's all kinds of rules around that too.
Yes.
Okay, but roughly it's about 18%. So you'd have $18,000, I'm just going to ballpark it,
Yes.
that you could put away
Mm-hmm.
into this year into an RRSP.
Yes.
Okay, that money you put in this year gets subtracted from the income you earn this year. So if I made $100,000 again,
Yeah.
that $18,000 that I put away into an RRSP is a deduction from the $100,000.
So instead of 100,000 income in 2025, now it reduces by 18,000. So
Yes.
my income is lower.
Yes.
Right, for CRS tax purpose.
$82,000.
$82,000. So
Right.
they will tax me on $82,000
Yes.
instead of $100,000.
Yeah, you claim the whole $100,000.
Mhm.
You take the deduction of any pension contributions you made, any RRSP contributions you made, and that goes down to what we call net income. So we include all our income into our, right?
Yes.
Into our T return.
Yes.
Right?
Yeah.
Oh, senior moment.
Yeah. I have them too.
Yeah.
So I'm getting up there.
So we claim all our money in,
Yes.
and then there's a bunch of deductions we can take.
Yes.
And so what it is, it's income in,
Yes.
okay? Division B income in.
Mm-hmm.
Division C deductions gives us a net income. Division B income.
Yes.
Net income, okay?
Yes.
And then we get Division C deductions, okay? Which gives us to taxable income.
Yes.
So the taxable income is what we pay taxes on. So even though I might earn $150,000, my taxable income by the time I finish might only be 110.
Okay. Because of all the deductions.
That's right.
And RRSP is one kind of deduction.
That's right, is one kind of deduction. And then I take my own personal situation and I figure out all the tax credits I'm eligible for.
Yes.
And then I figure out the dollar amount of my tax credits.
Yes.
And then this is the tax I owe on my taxable income. These are my tax credits. So the tax credits are subtracted from the taxes I owe.
Yes.
Now, if I paid more taxes than my tax credits,
then I get
a refund. So they're not giving me money.
Yes.
They're giving me my money back because I overpaid.
Makes sense.
And if I didn't quite pay enough, then they say you need to write me a check.
Oh, okay. So that's how it works. And RRSP is one kind of tax
deduction.
One kind of deduction. Now, if I put something in RRSP, right? Let's say the same thing. We bought $100 stock. It went to 200. Now, can I sell?
You can sell and buy in your RRSP.
Yes.
Right? No impact.
So no impact.
But no benefits.
No benefits.
Dollar for dollar when you take it out, that's when you're taxed on it.
Okay, so if 10 years pass by and I withdraw that $200, so then it becomes taxable?
Yes. So whatever your income is during the year you withdraw it, that's the marginal tax rate that you're paying on it.
So people need to understand it's not tax-free like a TFSA.
No.
Whenever you withdraw from an RRSP, you will have to pay taxes.
Yes.
Right? And
it's dollar for dollar.
Dollar for dollar.
So if your stock made $100,
yes.
In the RRSP, when you draw out that $100, you include the whole $100 into your income.
Wow.
If it's a non-registered account at the moment at a 50% inclusion rate, only 50% would be included. So that's what you need to be thinking about when you're thinking about all these different vehicles for tax planning, right? Now the assumption is, so an RRSP vehicle is deferring taxes.
Okay.
You will eventually need to pay taxes on that money. But it's down the road.
Okay.
When you're making less.
But is that always true?
Sometimes we're making more.
Yes, because that so it depends on situation to situation.
That's right. So, but one of the key things is if you're in the lowest tax bracket now, don't contribute to an RRSP.
So TFSA would take priority, right?
Yes.
If you have a lower tax bracket. But if you're in a very high tax bracket, it makes sense.
It makes sense to defer because any dollar I don't give the government now is a dollar in my pocket that I can spend.
Yes.
And it grows tax exempt in the RRSP.
Yes.
Right?
Tax deferred.
That's right.
Now, in a couple, let's say...
in the RRSP itself, you're not taxed on money while you're earning it in the RRSP.
So all the dividends, all the interest that is coming in... It's
sitting there and you don't have to include it into your income.
You don't have to pay taxes on that?
No, until you take it out.
Until you sell it, that's when you have to...
No, when you take it out.
When you take it out, you have to pay taxes on it.
That's right.
Wow, that's great. So, in a couple, if one person is earning higher and one person is earning lower, so it's a good strategy because that's what we do. The higher earner members put more money towards RRSP, the lower earner member focuses more towards the TFSA.
Yes, and the higher income on a spousal situation, right? If you have a partner, a life partner, the higher income can put money into the spouse's RRSP and deduct it from their higher income.
Wow, so that's a great strategy. So can you just elaborate?
Let's put some numbers in.
one person earning 200,000, the other person earning 50,000.
Yes.
Right. So what can this 200,000?
So this
person do?
200,000
Mhm.
is paying 47% tax.
Yes.
This 50,000 is only paying 25% tax.
Yes.
So if they put money into their RRSP,
Mhm.
they're only saving 25%.
Okay.
If the 200,000 puts it into in the spouse's spousal RRSP,
Yes.
then they get to claim the deduction
Mm-hmm.
and they get 47% back.
Now, when the spouse withdraws money,
It becomes
Will-
the spouse's income.
this becomes spouse's income.
As long as they
Yes.
don't withdraw it within 3 years of the spouse making a payment to it.
Okay. So 3 years is the
So
time
you
period
have to
be
wait
careful.
3 years right now.
But if you're, let's say, young and you're
Oh,
saving up
yeah.
for retirement, like just
Yes.
park your money
Yeah.
in the lower spouses.
Yeah.
Because that's more like tax efficient.
Correct.
Yes. Wow, that's great. So that was RRSP. So whatever money you put in, you get a deduction. When you take out money, you will be taxed on it. Probably at a lower rate if you're earning less
Yes.
during that time, right?
That's correct.
Then the third is like non-registered account. So what happens in that?
Just an investment account.
Just an investment.
So a
account.
non-registered investment account is anything you earn
Mhm.
or get distributions from, either capital gains or dividends,
Mhm.
you must claim into income the
Okay.
year you make it.
So I get some dividend from JP Morgan or Royal
That's right.
Bank. I have to claim it in the income.
That's
I have to
right.
pay taxes on it.
Yes, correct.
And interest income, GICs,
Everything.
same thing.
Everything.
Okay.
Yeah.
So that's the non-registered account.
Yeah.
So more or less we talked about couple living together. What happens when they have a kid? Are there any tax efficiencies we can find there?
Well, you can do RESPs, which is a registered education savings plan.
Mm-hmm.
Now, what's good with an RESP is depending what income bracket you're in,
Mm-hmm.
the government gives you a top up to
Okay.
20% of $2,000 that you
Mhm.
put in. So if you're in a lower income tax bracket,
Mm-hmm.
okay, I'm not too sure, I think it's under 90,000.
Mhm.
Family income.
Mhm.
It works on family.
Okay.
Okay, so if you put $2,000 into a registered education savings plan, the government that year will, at the end of the year, when they see that you did that, they'll give you $400 in the registered education savings plan.
Okay, so just for people to understand, let's say I have 2 kids and I put $1,000 each,
Yes.
right, in both of their RESP
That's right.
plans. So do I get something back?
You don't get anything back.
Mm-hmm.
Those go in. You
Okay,
can't
so
deduct it.
$1,000 go. in.
It's gone.
Yeah, it's gone.
But the government has given you a
Mhm.
grant.
Okay.
It's an education grant for your children that they
Mhm.
put it into the RESP. Now that you're going to take it and you're going to buy stock with it, or you're
Yeah.
going to buy GICs with it, or
Yes.
you're going to do something with it in there so that you can get dividends and capital gains and stuff like that. So that when the child goes to school,
Mm-hmm.
they use that and claim that part into income.
Okay, so $1,000 each I put in. 20% is
They got
rate.
1,200 each.
So 1,200. So government effectively gives free money,
Yes.
right, for $200.
Correct.
And
That you
you can do
invest.
whatever with it. You can, let's say, buy like stocks or ETFs or mutual funds.
Correct.
Right. Let them grow,
Yes.
and when they mature, right,
Yes.
when they are
Yes.
going to school, they can take that money
Yes.
out and
Yes.
study.
And while the money's growing in there,
Yeah.
it's not impacting, it doesn't need to be included into anybody's income.
Okay, so it is tax deferred like RRSP.
Yes.
Until it's withdrawn, you don't have
That's
to
right.
worry about it.
And it won't be you withdrawing it.
Wow.
Now, you could go to an institution,
Mhm.
and you got to be really careful with institutions and RESPs. You got to read the fine print.
Yes.
Because it could be your child doesn't go and you
Mhm.
lose all the money.
Wow.
Or you lose everything that increased and you only get a return of contributions.
Mm.
So you have to be very careful with RESPs. You need to
Mhm.
read the fine print of what happens if your child doesn't go to school.
Mm-hmm. Wow. So that's good to know.
Right?
Any other things they can do like when they have kids?
Not really, but if you file your taxes
Mm-hmm.
and get a social insurance number for the child the day it's born,
Yes.
now you're eligible for the child tax benefit.
So what is a child tax benefit?
So the child tax benefit is money given you that's tax free,
Mhm.
doesn't get included into income from the
Mhm.
federal government, So it's our tax money going to them and coming back to you because it costs to raise kids.
Yes.
Right?
I certainly know that.
Yes, it does. Any other extra person you put into your household costs more money. However, little children need babysitters, daycare, after school care, before school care. They need buses to go. They go on trips. They're constantly growing out of clothes. It costs money, right?
Yes.
So to offset that burden, especially for lower income families, we have a tax benefit, child tax benefit, that gets paid to you monthly as long as you've filed your taxes and your family income is below a certain amount. Now it's prorated. The more money you make, the less you get.
Okay.
Okay? So it's really geared. If I'm making $1 million
So it is
a year,
income tested.
that's right.
Yes.
I'm not getting, if I'm making $1 million a year and I could have 18 kids and it doesn't make any difference, I'm not getting a penny.
Okay. But like if you are below a certain level, you will get that.
Correct. Which changes every year. So I'm going to ballpark $90,000.
Wow. So that's one thing.
Decreasing, yeah.
The second part is like, let's say they hire a babysitter in the evening. Like, can they claim certain parts?
So if you hired the babysitter to go to work and earn money,
okay,
then it is deductible up to a certain amount against the money you've earned.
So sending to day homes, right?
Yes,
like, and
correct.
You're eligible to. And
yes.
who can claim? The person who has higher income or lower income?
So it's the higher income normally that claims the amount.
Okay.
But it's based on the lower income salary.
Okay, so it's based on the lower income salary, but the higher income. So there is way.
There's rules.
There are rules.
Right. There's a maximum amount.
Yeah.
That's right. There's rules. You got to calculate. It's make sure that it wasn't a sports program only and stuff like that. You have to earn money, right? And then it's based on 2/3 of your net income, yours, mine, and also within the restrictions on whether they went to day camp or whatever. There's restrictions of maximum amount per week that is eligible. So even though you paid $2,000, it might be only $400 is eligible for that week, right? And then you do the least of the three amounts.
Okay, and then claim it.
Yes.
So please look into it if that option is
and it's usually the lower income that actually claims it.
Okay.
Unless the lower income was in school. Okay.
Then they
or incarcerated.
Okay. So usually the lower income person claims
it's general rules.
Claims the amount.
Yeah.
Now let's say they have a kid and they're looking for buying a house. So I was just reading about this, and like there are two kinds of houses: primary residence and like secondary residence or something. So is there a tax difference between primary and secondary?
Definitely. So your primary residence at the moment, and it could change because I've been discussing this for the last few years to actually put capital gains on your primary residence.
Okay.
So, but right now, this is my primary residence.
Okay.
If I sell it, that gain is included in income. However, we have a formula because it's my primary residence that I calculate the formula out, and that gives me a capital gains deduction for a principal residence. And if the whole time I lived in it, it was a principal residence, then right now those two net to zero.
Okay,
so I claim the gain, and then I get the principal residence for deduction, and then it's wiped out.
So effectively, like if the family buys a house for, let's say, $300,000, a condo maybe, and they wait for a few years and they sell that house, they live in that house and they sell that house, right, for $500,000, so $200,000 gain. So that gain will be tax free. That
gain is taxed. However, you get the principal residence capital gains deduction.
Exemption. Yeah.
Yes.
So effectively you don't pay tax.
Yeah, but you have to be careful with your terminology. It's not tax free.
It's not tax free.
Because all they have to do is tweak that formula.
Yes.
And a percentage of it will be taxed.
Taxable. Okay.
And that's what they've been discussing.
But that's when you live in that house. If you're not living and renting the house, it's not eligible.
So what it says in the Income Tax Act is you ordinarily inhabit it. Okay?
Okay.
So there's a little bit of tax planning strategy. Say I have a cottage and my cottage went up in value a lot more than my house.
Mm-hmm.
If I've ordinarily inhabited that, meaning gone and lived in it,
Mm-hmm.
and haven't claimed capital gains allowance on it, right?
Yes.
Then I can claim that as my principal residence,
Makes sense.
right?
Yeah.
So that's a little bit of tax planning for people who have enough income
So
to own
effectively the higher value asset, right, like a cottage,
higher gain.
higher gains asset can effectively you tax plan around it.
And you tax plan, you work it out, right?
Okay.
Get an Excel spreadsheet, go
best
through
way
the
to go to
formula
a
and
CPA.
work it out. Go to a
Yeah.
CPA.
Yes.
Yeah.
So because like we are talking about primary residence because that is one of the main wealth driver for Canadians, right?
Main GDP driver.
Main
too.
GDP driver
Yeah.
too, because a lot of people have created wealth using real estate.
Yeah.
So if you have a primary residence, till now it is not tax.
It
Means
doesn't
you get
impact your tax.
It doesn't impact your tax. That's
It's
the
a wash.
right way to put it.
But you have to file. Right now, you have to tick off that you sold the house.
Yes.
And that you got to claim it for the principal residence, and you got to say the years you claimed it as a principal resident. You're only allowed to claim one principal residence for each tax year,
Okay.
right? So when you sell it, that's where you make the determination. Do I claim it, or do I claim my cottage when I go to sell it? Like, do my math, figure out.
Makes sense. So, like, it's a good idea for them to look at a primary residence because the wealth creation in that will be tax free.
Yes, it's a good way to get.
Yeah.
It is.
Yes.
Right, because you don't have to live in your house when you retire. You can sell it
And downsize.
and downsize, or if you really like your area, you can get a reverse mortgage on your home, right? Those CHIP reverse mortgages are a very good way for seniors to look at staying in their own home, depending on your situation, right?
Great. So the kids have grown old now, right? The couple is nearing retirement or almost on the threshold of retiring. So what are the tax planning strategies for people who are retired?
So the same as with a couple. If I don't make any money, we can transfer part of my basic personal amount, my disability amount, right?
Yes.
But also if I'm over 65 or I have a third-party pension plan, like an independent pension to me, not OAS, not CPP, I'm not talking about. Okay, I'm talking about a LAP.
Yeah, employer
provided pension plan. I can, under 65, I can split that with my spouse.
Okay, so if I'm getting, let's put some numbers, $100,000 from my employer and my spouse is not getting anything from the employer, then I can transfer 50% to her. So 50,000 taxable to her, 50,000 taxable to me.
So both of you are in the lowest tax bracket of 15% now, whereas before you were moving into the third tax bracket.
Okay. So that's one.
Just straight off the top, right?
And what is this pension tax credit?
Oh, and then you get, because it's a third party employer provided, you get $2,000 tax credit for the pension. So it's a tax credit. So 15%, people say, well, it's still, it's $300 of taxes I get back to me or I don't have to pay.
So effectively, if I just took pension on my name, $100,000, I would get only $2,000 of tax credit.
But you share it.
If I share it,
an eligible pension,
then I get $4,000. Yeah, 2,000.
Yes, tax credit. Well, that's the base amount.
15%
of it. Our basic tax is usually, if our basic tax bracket is 15%, then usually our tax credits are at 15%.
Okay.
When it goes up to 16%, usually this goes up to 16%.
Yeah.
No law that says it does.
Yeah.
But that has been the historic now.
Yeah. So that's the employer pension.
Yes.
We do get pension from the government too, right?
Well, if you've paid CPP,
yes,
you get pension from the government. It's
so
only
CPP
been the last
Canada pension plan.
Yes.
So what is that? Like we contribute?
We contribute, and your employer contributes. Okay, and with CPP, what's really good is when you're working, CPP actually is a long-term disability plan.
Okay.
So as a pension return, it only gives returns like 2% per year when you go to collect. It is only, your return is very low.
Yes.
But for the money you pay into it, it's a very inexpensive long-term disability plan.
Wow.
So if you get injured or sick on the job and you can't work anymore,
Yes.
after 2 years, or if they determine right away you can't work anymore, you go on disability CPP.
Okay.
And that continues until you're 65.
So that's a good disability plan then.
Right, that's a really
Yeah.
good one. And you cannot get a disability plan for $2,800.
So it's a good idea to pay CPP.
Very good idea to pay CPP, right? Huge.
Yeah.
And the CPP picks up because your employment insurance plan is your short-term disability plan.
And
EI.
this is a long-term one.
And CPP is for long-term disabilities.
Okay.
Right? And I know people who have drastically benefited
Yes.
from having paid CPP, getting permanently disabled, getting cancer or some dementia disease, right?
Yes.
And you can't work anymore.
So you can claim
So
disability.
then they pay you a CPP disability pension. And while they're paying you the pension, they're paying you the CPP on it too for you, so that you actually have CPP when
retire.
when you're 65, right?
So when you retire and you get CPP, is that taxable?
That's definitely taxable. And it
Okay.
can't be split
Okay,
after
it
the
cannot
fact.
be split.
But it can be split before the fact.
Okay.
So if
Mm-hmm.
one person makes a lot more CPP than the other, because some people stay home for your kids, you got
Yeah,
whichever
yeah,
male or
lower
female,
income. Yes.
doesn't make any difference. Some
Yes.
people don't have the same earning power as
Or
others.
maybe
over the same
your
length of
spouse
time.
came into the country later than you.
Yes,
Right,
that
that's
works
very-
too.
yeah,
that's huge,
yeah.
right?
Yeah.
Then you can,
Mm-hmm.
before when you fill out your form to take your CPP, you can ask to split the pension with your spouse.
Okay.
And they work out how long you've been together and which percentage of that CPP can be split.
Mm-hmm.
So you would get the check,
Mm-hmm.
and then your spouse will get a check when you're both eligible for CPP.
Wow.
Right? So you could say, you know what, I'm going to split, and she says she's going to split, and then you're both 60. Say you both turn 65 the same year.
Yes.
So they add it together and they split it out, and you've been together since you were 18. So the whole
Yes.
thing gets divided in half, and you get half, and she gets half.
Wow.
That's it. So that's before the fact.
Yes.
But if you don't do that,
Then
you can never
cannot
split CPP.
But CPP is contribution based. You contribute.
Yes.
And based
time.
on time and contribution, and you get
Yes.
money from the government.
That's right. And in order to record that, you must file your taxes.
So it's going back, like you have to file your taxes.
Yes.
Great idea to do that. Then what is this old age security?
So old age security was brought in,
Mm-hmm.
was actually brought in because 40 years ago, 50 years ago, men worked when stayed in the home.
Mm.
The pension was in the husband's name.
Okay.
The husband passed away,
Mm-hmm.
pension benefits went with the husband.
Oh,
So now we had a lot of spouses with no income and
Okay.
living in poverty.
yes.
So they came out with old age security, and they said, okay, blanket across the board. If you've been a resident of Canada for 40 years,
Yes.
40 years of filed tax returns
Yes.
since you were 18,
Yes.
then you're eligible for the full OAS.
Okay.
Okay?
Yeah.
So that is just old age security. So it gets given to me by the government.
It's not based on contribution.
It's not based on contribution.
It's
You may
based
never
on-
have worked. You may never paid a penny in taxes.
Yes.
You will get a set old age security amount.
Okay.
However-
Based on residence.
Residency is the amount,
Mm-hmm.
and also it's income tested.
Okay. So if
So
you
it
have
starts
higher
getting
income.
clawed back.
Mm-hmm.
Okay, so right now, if you make more than $96,000 a year, they start clawing it back. You don't get as
Okay.
much until it's totally wiped out at I think 124,000 or something.
Okay.
So for every dollar you earn over the limit, you
Mhm.
lose 15 cents of OAS.
So again, because it came to my mind, splitting could be a
You
good
can't
option.
split
No,
OAS.
not old age security, but pension. If you split, you might save on
You might the clawback.
the clawback. Might help.
Correct.
Yeah.
That's huge. When
Wow.
you're retired, that's huge,
Mm.
right?
So that's a great point. So old age security is given based on your residence.
Yes.
And it is taken away if it
Based on
starts to
income.
go away when you start earning more than a certain amount.
Yes, correct. It's income tested.
It is income tested. That is the second layer of retirement. Like third is like the GIS one, right? Not everyone gets it.
Guaranteed income supplement. The guaranteed income supplement is for those people that are making in their senior years on OAS, they're making, it's a little, I think it's probably 19,000 now, I don't know, it's under 20, okay? So if that's your income, then the government will top it up a few $1,000s.
Okay.
Right? So, and with that also, and you have to file your tax return to get it.
Yeah. So
if you don't file, you don't get it.
Yeah.
Some provinces also will have your property taxes because you're on guaranteed income supplement.
Okay.
Some provinces have free drugs if you're on guaranteed income supplement. There's a whole slew, like they'll pay for your glasses and stuff like that, your medical, if you're on guaranteed income supplement.
But is it considered like as a couple income or is it individual?
It's single and a couple. If you're living by yourself, it's got one threshold. If you have two people, it's another threshold.
Okay.
Now, I don't ever want to get guaranteed income supplement.
Yes.
I don't want to be down there.
Yeah.
Right?
Yes.
But for people who need it, it's awesome.
It's awesome. And if you have TFSA, it will not impact.
It doesn't impact that.
Okay.
But a withdrawal from an RRSP
will do it. And same with OAS, like old age security.
Yes.
So if I'm assuming, I have $300,000 in a TFSA by the time I retire. So withdrawing from that will not impact my old age security.
No.
But let's say if I have an RRSP and if I withdraw, then old age security will could be impacted. So TFSA has no impact whatsoever on pension.
Not at this point in time.
So for young people, it's a great tool to accumulate retirement, right?
Put money into TFSA.
Max it out.
Yeah, and save the RRSP room.
Yes.
Until you're the CEO of the company and making $350,000 a year, and you need a $50,000 deduction.
Yes, then use it.
Then use it. Save it, right? Because you don't want to put money away when you're earning nothing and you're only paying 15% tax. Because remember, I can pay 15% tax now and put $1 away in my RRSP, save 15 cents on the dollar. When I pull it out, the tax rate could be 18%. So I'm now paying 18% on that same dollar that I could have only paid 15% on.
Makes sense.
Better to save 47 cents and then pay 15 cents later on. Now and don't forget when you're 71 and you're thinking about changing it to 72.
Yes.
But when you're 71, December 31st, the year you turn 71, you have to roll your RRSP over into a registered income fund.
Yes.
Where you are obligated to claim into income a certain percentage every single year based on your age. Starts out at 5%, roughly around 5%. And when you're in the 90s, you have to take 20% a year out.
Now, like I read somewhere, because most retirees, they might want to move out of Canada, go to warmer pastures, right? Florida and stuff. Does that impact old age security?
Yes.
Okay.
You have to be a resident of Canada.
In the year that you're going to get it?
You have to be, yes. If you move out of Canada, you don't get it in.
You don't get the old age security.
No, but the CPP is yours.
CPP still you get, but old age security you won't get. No. So people who are looking to move out, if
you're no longer a resident of Canada, they're not going to support you.
Okay.
With it's social assistance, right?
Yeah. But maybe few months you can still stay and come back and claim old age security, or
are you moving or are you visiting?
Okay, that's
There's a whole slew of things you have to go through when you move.
Okay, makes sense.
If you're planning on not being a resident of Canada anymore, I can live somewhere else and still be a resident of Canada for tax purposes and OAS.
Okay. So complexities, better to do your own research, but that's a thing.
Do your own research, call the International Tax Office, and don't forget rules change.
Okay. And the third part is, I was just looking at it before the show, that the older folks spend a lot on medical expenses, right? So is there any help that they can get from the tax system if they're spending a lot?
Yes. So we have medical tax credits.
So what is that?
So a medical tax credit is anything you spent medically that's authorized by a doctor and going to a chiropractor, right? Prescription drugs, premiums on health insurance are all a tax credit. Okay, if you've paid for it. Now, if I have a health plan, so I got $200 of prescriptions, they picked up $190, I paid $10. It's only $10 that goes into
The tax credit.
The tax credit, right? So it's money that you paid, not your health premium paid.
So,
okay,
just numbers. Like I'm a retired person, I pay, let's say, $5,000 out of pocket for my medical expenses.
Yes.
So when I file taxes, I get a credit on that?
You get a credit on it based on a set amount gets deducted from it. So they say everybody's going to incur $2,900 in expenses. So $2,900 would be subtracted from the $5,000, and then the difference will be a 15% tax credit. Okay. Now your premiums too, but it's based on that base amount or 3% of net income, whichever is less.
So means more nuances there, but effectively, like if you have some medical expenses, look into it, you might be eligible for a medical tax credit.
And with medical expenses, it's family medical.
Okay, so I can spend on my
kids, spouse, and then you want the lower income one to claim it if they owe taxes. If they don't owe if they don't pay any taxes, there's no sense the lower income claiming it, right?
Yes.
But because they would have a lower net income, because that base amount is 3%. So if I only made $10,000, 3% of 10,000, my base amount is $300 getting subtracted from the 5,000.
Yeah.
Right?
So lower income person should look at it.
Should look at it. And then but you need to have paid or owe money after all your tax credits. If you don't have enough money left over, all your tax credits have wiped out the taxes owing, you don't claim it. Then the higher income spouse should be claiming it. Right?
So I think more or less we have covered ground. Like the last part that I want to talk about is, what if I want to leave my assets behind, right? I'm like old, like I have kids, family members that I want to, so is there any estate taxes in Canada?
So not what we would call estate taxes. There's probate fees to go through the courts and get your will settled, which is based on how much your estate is worth. Anything you've assigned as a beneficiary does not go into the estate.
Okay.
So everything you have should have a beneficiary on it.
So my RRSPs should have a beneficiary. My TFSs should have beneficiary.
Your health.
Insurance plans.
Insurance plans should have a beneficiary. Right. Everything should have a beneficiary to keep it out of your estate. Okay. To reduce the probate fees.
Yes.
Right. And then those get transferred right away too. Right. And executor fees are based on the estate also. So if it went right away to the beneficiary, your executor fees are
lower.
Right. So one thing you can't get away with in Canada, you can't not die, and you can't not pay taxes.
Okay, so there are death taxes.
The last thing you do, we don't call them death taxes. The last thing you have to do, because you've lived from January 1st to the time you die.
Yes.
Right? You've been a resident of Canada.
Yes.
You have to file your final return.
Okay.
So you don't know you're going to die, so your executor is responsible for filing your final return.
Yes.
And everything you have at that point in time is deemed to have been sold at fair market value. And any capital gains or losses will be taken into income at that time.
Wow. So if I have an RRSP I don't have a spouse, I have an RRSP for $500,000, so that will be considered sold.
$500,000 of income.
And if I have a house, same thing. If it is primary,
but principal residence, you fill all that out, right? Your executor, very key to have a good executor.
So isn't it a good strategy, like while planning for like death, to slowly give away assets rather than waiting at the last time?
Yes. So 2 schools of thought on that. There's been a lot of elderly people that have given away their assets, and the people, family members, have taken off with the assets and dumped them in a senior's home and
give what you can live without.
Right?
Do not give what you cannot live without. Thinking that their
children and grandchildren are going to look after them, right? Now, in general, families are very loving. I know it's happened. So I do have to caution against that because I know it's happened.
Yes.
Right? However, it's because you can give gifts. Right?
Tax free.
You can give tax-free gifts.
No probate fees,
No, I can give a gift, right? So I can gift my grandchildren. I can say, you know what, here's $10,000, go to university. Right? So I've given away some of my cash along the way when they really needed it most.
Okay.
Okay.
So 2 schools of thought. just be careful. Do not part away with assets that you require to live.
Yes.
Right? But apart from that, like if it's a tax efficient strategy to
start
give the assets,
doing it slowly so that you're
yeah.
taking small amounts of capital gains
Yes.
or income in, so you keep yourself in the lower tax brackets. So keep
Because-
yourself under $150,000, right?
Yeah.
Don't get into the surtaxes.
Especially, I was having a thought. A lot of people are single. They have those RRSPs and plans,
Yeah.
and like the moment the death happens, those RRSPs will be taxed at
Income.
47%,
Yes.
right?
Now, if you have a spouse, it's different.
If
you can transfer.
if you don't have a spouse, then
That's right. Just
yeah.
like a TFSA transfers,
Yeah.
if you've got them as the beneficiary.
Mm.
Okay.
Okay.
If you don't have them as a beneficiary, now you're in trouble.
Oh my god. Thank you, Val. Like it was a very good conversation. I hope it helps our listeners.
Yeah, I do
Right.
too.
Thank you so much. Like Val has been in taxes for a long time. She has taught taxes a lot and she's a CPA. So I hope this discussion helps you.
Yeah.
Research a lot. What is the best source of information about taxes?
Canada Revenue Agency.
So
It
CRA.
actually has examples, has mathematical examples. For the student one, go look at that student guide, read it through. They have real estate ones. You want to buy a house
Yes.
and rent it out? They have real estate guide. It shows you everything that's deductible, everything that needs to be included, right? They show you small business. They have small business ones. They show you how to do the calculations. You can give them a call, right? They'll talk to you. And if you're not getting a good answer, you need to go
Yes.
see your corner CPA.
Okay.
Not H&R Block, not
Yeah.
Liberty Tax, because they have basic programs. They won't
Yes.
deal with you as a unique individual.
It's yeah.
The CPA has a fiduciary duty to make sure you pay the minimum tax required. And that's just all I can say, right? And
So-
they're actually not as expensive usually as these big
And
companies.
their value is worth in gold,
Yeah.
right? Like the
Yeah.
fees that you pay is worth in
Yeah,
gold.
I'm not talking about going to the big KPMGs and
Yeah,
stuff. We're doing
no.
personal taxes. I'm talking about the corner CPA.
Yeah.
And if it says tax accountant, doesn't mean they're a CPA. It has
Check
to
it out.
say
Yes.
CPA.
Yeah.
Yes.
Thank you so much, Val. Great to talk to you.
Yeah,
Like,
I enjoyed
thank
it.
you.